Right now, more than $7 trillion of American cash isn't sitting safely in your typical bank account. That's trillion with a T, more than the entire annual GDP of Germany. And while most Americans are focused on their checking accounts or savings, a quiet shift is happening right under our noses. Money is leaving traditional banks at an unprecedented pace, moving into money market funds, ultra-safe, liquid cash alternatives that promise higher returns and instant access. But this isn't just investing. This is a silent bank run. And unlike the runs of the past, there are no lines at ATMs, no breaking news alerts, just an invisible migration of trillions of dollars that could reshape the U.S. banking system without anyone noticing. Welcome back to Economy Historian TV, the channel that digs into the hidden forces shaping your money and your future. Today, we're peeling back the layers of a financial story that is as shocking as it is overlooked. We're going to explore why banks are losing deposits, where the rich and institutions are hiding their cash, and how this quiet exodus could affect your savings, loans, and the economy at large. By the end of this video, you'll understand why this $7 trillion surge into money market funds isn't just a curiosity. It's a signal of deep stress in the U.S. banking system, and why it matters even if you don't consider yourself wealthy. Stay with me, because the forces at play here are unseen, urgent, and could have consequences for everyone with money in the system. Money market funds, or MMFs, are a type of mutual fund designed to act like a hybrid between a bank account and an investment vehicle. At their core, these funds pool money from thousands of investors and invest it in ultra short-term debt instruments, such as Treasury bills, commercial paper, and repurchase agreements. The primary goal of a money market fund is stability and liquidity. Unlike stocks or long-term bonds, the value of a money market fund is generally intended to remain at $1 per share, meaning your principal is preserved while you still earn a small yield. This makes MMFs feel very similar to a checking or savings account, but with the potential for higher returns. Essentially, it's a place where cash can sit safely and earn something above the negligible interest rates that traditional bank accounts often offer. People are increasingly turning to money market funds for several practical reasons. First, they often offer higher yields than traditional bank savings accounts, especially in times when banks' deposit rates lag behind market interest rates. This makes MMFs particularly attractive for investors who want to earn more on their cash without taking on significant risk. Second, these funds provide immediate liquidity. You can withdraw your money at almost any time, making it a flexible option for individuals or businesses that need quick access to cash. Finally, MMFs are widely regarded as a safe parking lot for money during periods of financial uncertainty. Unlike stocks or long-term bonds, which can fluctuate in value, MMFs provide a stable place to hold funds while still earning a return. To put this into perspective with a simple example, imagine a traditional savings account that offers 0.5% annual interest. At the same time, a money market fund may be yielding 4 or 5%, sometimes even more depending on short-term treasury yields. For ordinary investors or even institutional money managers, this difference is significant enough to prompt a shift. When people see the opportunity to earn 8 to 10 times more on the same cash, moving money from a bank account to an MMF becomes almost inevitable. Over time, these small individual decisions accumulate, contributing to the massive inflows into MMFs. And this is exactly what we're witnessing in the U.S. today, with over $7 trillion now parked in these ultra-safe funds. It's a reflection of both rising interest rates and growing caution about traditional banks, signaling that investors are increasingly seeking stability and higher yields in a volatile financial environment. When we talk about a $7 trillion money market fund boom, we're not talking about a small blip or a temporary shift. This isn't a rounding error on a balance sheet. It's one of the largest pools of liquid cash anywhere in the U.S. financial system. In early 2025, money market funds, those ultra-short-term cash-like investment vehicles, hit a record $7.03 trillion in assets under management. And by the start of 2026, they'd climbed even higher, with some figures showing money market assets approaching $7.8 trillion as investors poured money in during the first days of the year. To understand just how dramatic this shift is, consider this. At the end of 2022, the entire U.S. money market fund universe was around $5.2 trillion. Since then, it has swelled toward and beyond $7 trillion, an increase of roughly 35%, 50% in just a few years. Even more striking is what type of money market funds account for this growth. Over 80% of these assets are in government money market funds, the safest category that invests primarily in U.S. government securities and secured repurchase agreements. So why have so many trillions shifted into this corner of the market? There isn't one single reason. There are several powerful forces, all pointing in the same direction. The first big driver is interest rate dynamics. Over the past few years, the Federal Reserve raised short-term interest rates aggressively to combat inflation. Because money market funds invest in short-term instruments, their yields tend to rise rapidly when rates go up. In contrast, banks are often slower to adjust deposit rates because boosting what they pay on savings eats into their profit margins. As a result, for long stretches, money market funds have offered yields significantly higher than what normal bank deposits pay, making them far more attractive as a place to park liquid cash. Secondly, there's fear and uncertainty about banking stability. After banking stress events, including regional bank troubles and the broader concerns raised in 2023 and beyond, many depositors have become wary of keeping large balances in traditional bank accounts. They're not lining up outside branches, but they are moving electronic deposits out of banks and into money market funds. This is especially true for corporations and wealthy investors with millions or billions in short-term cash to manage who prefer the safety of government-backed MMF assets and the flexibility to access them on short notice. Another factor is corporate cash management. Many companies view money market funds as a sophisticated place to store operating cash because MMFs offer liquidity and yield without the same regulatory constraints as bank deposits. Institutions tend to pour huge sums into government money market funds because they're judged to be nearly as secure as cash itself, yet they deliver a noticeable return relative to a zero-yield checking account. When you visualize this movement, trillions leaving traditional bank deposits and entering funds, it sends a strong signal. Depositors and institutions are voting with their feet, preferring safety, liquidity, and yield over the relative comfort of bank deposits. This phenomenon is one reason analysts describe the surge as a kind of silent bank run, not in the dramatic physical sense of the Great Depression, but in its economic effect. Money that would traditionally have stayed inside banks, funding loans, mortgages, and commercial activities, is now sitting in ultra-safe vehicles outside the traditional deposit ecosystem. To put it in perspective relative to broader money in the economy, that $7 trillion parked in money market funds represents a huge slice of the U.S. liquid financial system. It's equivalent to roughly 31% of certain components of the U.S. money supply. For example, the demand deposits and other checkable deposits that make up part of M2. As money moves out of traditional bank deposits and into MMFs, banks end up with less funding, which affects their lending capacity and could reshape credit conditions in the broader economy. So this isn't just a statistic to toss around on a chart. It's a fundamental shift in where cash is being held and why. Whether this trend continues, reverses, or morphs into a broader crisis depends on interest rates, confidence in banks, and economic conditions in 2026 and beyond. But for now, the $7 trillion money market boom stands as one of the clearest indicators that capital is searching for safety, liquidity, and yield outside the traditional banking system. And that has real implications for everyone with money in the financial system. A bank run is a situation where a large number of depositors simultaneously withdraw their money from a bank because they fear it might fail. Historically, we picture people lining up outside branches, clutching cash as panic spreads, a dramatic, almost cinematic event. But the modern financial system has quietly transformed the way these runs happen. Today, instead of forming lines at ATMs, depositors and institutions are moving money electronically into money market funds, creating what experts are calling a silent bank run. There are no sirens, no news flashes, just a steady outflow of deposits from traditional banks into liquid, high-yield alternatives. The evidence for this shift is clear. Bank deposit growth has slowed significantly, while money market funds have expanded at a record pace. The $7 trillion parked in MMFs, most of it in government funds, reflects a growing caution among investors who want their money accessible but safe. In effect, depositors are voting with their feet. They are choosing liquidity and stability over keeping funds in bank accounts, signaling a lack of confidence in the traditional banking system. This isn't a speculative trend. It's a behavioral shift that could have tangible consequences for banks' operations and the broader economy. It's important to clarify that this isn't a bank run in the classic sense. Money market funds do not trigger immediate bank insolvency because the funds themselves are separate from bank balance sheets and are not insured by the FDIC. However, they do reduce the bank's available deposits, which are the lifeblood of lending and profitability. As deposits flow out, banks have less capital to issue loans, mortgages, or finance businesses, which puts pressure on their balance sheets and reduces their ability to generate income. In simple terms, this silent migration of money behaves like a bank run without the chaos. Cash isn't under the mattress. It's in liquid safe funds. Yet the economic consequences are real. Banks must adapt to this shrinking deposit base, which could lead to tighter lending, higher borrowing costs, or even consolidation in the banking sector. For ordinary Americans, this may not seem immediate, but it is a critical warning sign that the traditional banking system is under subtle but growing stress. And the way money is held and moved in 2026 is very different from what we've seen in the past. As the U.S. banking system feels increasing pressure from deposit outflows, a critical question emerges: where is all the cash going? The answer reveals a dramatic reallocation of capital away from traditional bank accounts and into liquid, high-yield alternatives, especially money market funds, MMFs, and beyond into short-term government securities. This trend isn't just about individual savers chasing yield. It's corporations, institutions, and wealthy investors strategically parking cash where it offers safety, liquidity, and better returns compared with bank deposits. The biggest beneficiary of this shift has been money market funds themselves, especially the government money market funds that now dominate the market. These funds are structured to hold ultra-short-term, low-risk securities backed by the U.S. government or collateralized by Treasuries. As of mid-2025, MMFs in the U.S. had swelled to about $7.5 trillion in total assets under management, with government funds accounting for more than 80% of that total. This reflects a collective preference by investors for the safest available cash-like instrument that still yields a meaningful return relative to traditional bank savings. Unlike a basic savings account that is insured and may pay next to nothing, these government MMFs invest heavily in Treasury securities and short-term repurchase agreements. According to official data, about $2.7 trillion of MMF holdings are directly in Treasury bills and related government securities, forming the backbone of what these funds hold as collateral. This massive allocation underscores how investors, from wealthy individuals to institutional treasurers, are using MMFs as a high liquidity parking spot for cash, especially in periods of economic uncertainty and rate volatility. It's not just individual investors making this move. Corporations across the U.S. have become active players in the cash reallocation trend. Many large firms prefer to hold their excess cash in short-term Treasury bills or in institutional money market funds rather than in bank deposits. That's because these instruments offer better yields and almost equivalent safety, while preserving the ability to liquidate instantly for operational needs or strategic flexibility. The rise in short-term Treasury yields, often in the 4% plus range, makes this shift financially sensible. Data also shows that many firms' cash allocations have shifted significantly toward yield-bearing Treasury holdings since 2021, as higher rates make holding cash more expensive if it sits idle and earns little. Institutional money market funds, those used by corporations, pension funds, and wealthy investors, play a particularly important role here. These funds are designed to accommodate very high minimum investments and offer some of the most competitive yields available outside of direct Treasury buying. Corporations often have cash sweep arrangements where excess balances automatically flow into MMFs overnight, effectively concentrating corporate cash into high-yield short-term instruments without manual intervention. Another layer of this story is Treasury bills themselves, which act as the underlying asset that gives MMFs their safety and yield characteristics. Treasury bills are considered virtually risk-free because they are backed by the U.S. government's full faith and credit. This makes them ideal for large cash holders who want to preserve capital while earning a return far superior to what they would receive in most bank deposit accounts. The fact that nearly $2.7 trillion of money market holdings are tied up in these government securities tells you that this is not a speculative bet. It's a calculated choice for liquidity and security. Taken together, these trends show that rich money, from both private and corporate sources, isn't disappearing, it's relocating. Investors are moving vast sums into money market funds and short-term government securities because they offer a unique combination of safety, liquidity, and yield that banks simply can't match right now. This shift reflects broader concerns about banking stability, interest rate expectations, and the desire to maintain ready access to cash while still earning a meaningful return. For the average viewer, it's a reminder that where money goes reveals what the smart money fears and what it values most in uncertain times. As trillions of dollars flow out of traditional bank accounts and into money market funds, the consequences for the banking system are significant. When banks lose deposits, they have fewer reserves to lend, which directly impacts their ability to issue mortgages, personal loans, and business credit. This reduction in lending capacity can slow economic growth because banks are the primary source of financing for much of the economy. In effect, the shift of cash into ultra-safe alternatives like money market funds squeezes the traditional banking model, which relies on deposits to fund lending and generate profits. Interest rates play a crucial role in this dynamic. If the Federal Reserve decides to cut interest rates, the yields on money market funds may decline, which could incentivize investors and corporations to move their money back into bank deposits or even into riskier assets like stocks. On the other hand, if rates remain high, cash is likely to stay parked in MMFs, putting ongoing pressure on banks as they compete to attract deposits. This tug-of-war between rates, yields, and deposit flows creates an environment where banks must adjust their strategies to maintain liquidity and profitability. Liquidity stress indicators further highlight the tension in the system. Analysts have recently noted that U.S. bank reserves are at multi-year lows, signaling tighter liquidity than what banks have experienced in recent decades. Low reserves make banks more vulnerable to sudden withdrawals or unexpected demands for cash, forcing them to operate more cautiously. While this isn't a crisis yet, it's a warning sign that the traditional banking system is under strain, even without dramatic headlines. For everyday Americans, the implications are real. Lower bank profitability may translate into fewer loans available, higher borrowing costs, or stricter lending standards. The migration of cash into money market funds reflects fear and caution among wealthy investors and institutions, which can be a leading indicator of broader market sentiment. For individual savers, money market funds may appear attractive because of higher yields and liquidity, but they lack FDIC protection, meaning that your money is not insured in the same way as a bank deposit. Understanding this landscape helps you see that the flow of money is more than numbers on a balance sheet. It affects how banks operate, how much credit is available, and ultimately, how your personal finances can be impacted in 2026. So, is America experiencing a silent bank run? The answer is nuanced. While there are no panicked lines outside bank branches or breaking news of widespread withdrawals, the steady, sustained movement of trillions of dollars out of traditional bank deposits and into money market funds tells a story of caution, fear, and structural change. This isn't just a temporary trend. It reflects a broader shift in how money is being stored, managed, and protected in today's high-interest, high-uncertainty environment. Corporations, wealthy investors, and everyday depositors are all voting with their dollars, prioritizing liquidity and safety over the traditional comforts of bank accounts. This migration signals that while banks remain operational, their role as the primary custodians of cash is being quietly challenged. To visualize this, imagine a split-screen comparison. On one side, banks losing deposits steadily over time, shrinking their lending capacity and putting pressure on their balance sheets. On the other, money market funds swelling with cash, offering security and yield that traditional banks struggle to match. It's a striking contrast that shows how, even without a public panic, financial behavior is shifting in ways that could reshape the banking system and influence the economy in subtle but profound ways. Now, take a moment to reflect on what this means for you personally. With banks becoming relatively less attractive, what would you do with your own cash? Would you keep it in your bank account, move it into a money market fund, or explore other alternatives? The decisions of ordinary people, when multiplied across millions of accounts, are what drive these trends and ultimately signal broader confidence or fear in the financial system. If you want to understand these hidden financial currents and how they affect your money, your loans, and the economy as a whole, make sure to subscribe to Economy Historian TV. Hit the bell so you never miss a deep dive into the forces quietly shaping the financial world, like this silent bank run. Don't forget to like and share this video with friends and family. It's crucial to be aware of how money flows today because it can impact everyone, whether you realize it or not. And most importantly, comment below with your thoughts.